Welcome to the Riskwiser Zone, the show where we dive into the world of stocks and finance to help you make informed decisions about your investments. We're starting off with a story that's been making waves in the energy sector, the ongoing conflict in the Middle East, and its impact on global oil prices. As you may know, tensions have been escalating between Iran and other countries in the region, leading to concerns about disruptions to oil supplies. According to reports, Iranian drone attacks have forced Saudi Arabia to shut down its Ras Torah refinery, while Iraq and Saudi Arabia have curbed crude production due to filling up their oil storage facilities. Goldman Sachs estimates that the real-time risk premium for crude oil is around $18 per barrel, corresponding to a 6-week full halt to tanker traffic in the Strait of Hormuz. This has led to a surge in oil prices, with some analysts predicting further increases if the conflict continues to escalate. However, it's worth noting that OPEC Plus has announced plans to boost its crude output by 260 barrels per day in April, which could help offset some of the losses. Additionally, the U.S. Energy Information Administration has reported that U.S. crude oil production remains strong, with inventories currently at around 2.7% below the seasonal 5-year average. As always, we want to emphasize that investing in the energy sector can be complex and involves many factors. While some investors may see opportunities for growth, others may be more cautious due to the risks involved. It's essential to do your own research, consider multiple sources, and consult with a financial advisor before making any investment decisions. We'll continue to monitor this situation and provide updates as more information becomes available. In the meantime, we want to hear from you. How do you think the conflict in the Middle East will impact global oil prices? And what strategies are you using to navigate these uncertain times? We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're exploring the latest developments in the tech industry, and today we're focusing on two major players, Broadcom and Marvell. In our first segment, we discussed how Broadcom's deep partnerships with a small group of tech giants have positioned it at the center of the AI arms race. The company is helping design and supply custom silicon for the next generation of AI systems, which has led to a strong buy rating from Wall Street analysts. However, this concentration also brings risk, as the company's fate is heavily tied to the performance of these few powerful customers. Now, let's shift our attention to Marvell Technology, which has seen its stock rally significantly after posting strong Q4 results and issuing impressive guidance for the current quarter. The semiconductor firm cited robust artificial intelligence demand as a key driver of its growth, and analysts believe this trend will continue throughout 2026. Craig-Hallum has lifted its price objective on MRVL stock to $164. Indicating potential upside of 80% from current levels. It's essential to consider both the opportunities and challenges facing these companies. While Marvell's dominant optical interconnects and custom AI silicon programs with hyperscalers have driven record design wins, the company is not without its risks. The investment firm's bullish stance is justified by broad-based data center growth and accelerating artificial intelligence revenue, but other Wall Street firms have a more moderate outlook, with a consensus rating of moderate buy and a mean target price of roughly $115. As we weigh the pros and cons of investing in these tech giants, it's crucial to remember that the AI landscape is rapidly evolving. Companies like Broadcom and Marvell are positioning themselves for long-term growth, but the path forward is not without its uncertainties. Welcome back to the Riskwiser Zone. Today, we've been exploring the complex world of energy and finance, and now it's time for our closing segment. As the global economy continues to evolve, one thing is clear: the demand for innovative energy solutions is on the rise. In a recent development, Plug Power Inc., a leading supplier of hydrogen energy systems, is planning to offer hydrogen electricity in a potential special auction by the biggest U.S. power grid. This move comes as the U.S. faces looming power shortages, largely driven by surging consumption from data centers powering artificial intelligence. According to Andy Marsh, the company's chairman, Plug Power, is considering providing up to 250 megawatts of hydrogen electricity in the auction. The company would need contracts lasting at least 7 years and is already in talks with hyperscalers, data center companies, and utilities. This strategic move highlights the growing importance of hydrogen power in meeting the increasing energy demands of the digital age. As companies like Plug Power continue to innovate and expand their offerings, it's essential for investors to stay informed about the opportunities and risks associated with this emerging market. As we wrap up today's episode, it's crucial to remember that investing in any energy sector comes with its unique set of challenges and uncertainties. It's vital to approach these investments with a balanced perspective, considering both the potential benefits and drawbacks. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.